For almost a century, paper money was supposed to be as good as gold, backed by law, guarded in vaults, and trusted to hold its value. Yet behind official confidence, a sequence of crises quietly forced governments to revoke that guarantee. What really happened when the so-called gold anchor slipped? And how did that silent unraveling change the way every dollar works today? In 1873, Congress passed a law that quietly rewrote the rules of American money. The Coinage Act ended the free coinage of silver dollars, stripping silver of its equal standing with gold. From that point forward, the United States dollar was defined by weight, 25.8 grains of gold, 90% pure. The law did not mention paper money or promise that every bill could be exchanged for gold on demand. Instead, it established gold as the sole unit of value for new coins, aligning the United States with a growing international movement. Silver advocates called it the crime of 1873, but supporters argued it would bring stability and credibility to the currency. By removing silver from the monetary equation, the government set a single metal commitment that would shape financial policy for decades. Yet, for all its clarity, this legal foundation left one question unresolved. What guaranteed the value of paper money when so much of it circulated far beyond the reach of any vault? In August 1914, as war erupted in Europe, the United States quietly suspended the free movement of gold. Shipments stopped overnight, breaking the promise that dollars could always be turned into metal. Banks locked their vaults, and for the first time, the gold standard bowed to political emergency. 2 decades later, another crisis forced even deeper change. In the spring of 1933, President Franklin Roosevelt signed Executive Order 6102. Americans were ordered to hand over their gold coins and bullion to the Federal Reserve, facing up to 10 years in prison if they refused. The government bought the gold at $20.67 per ounce, stripping citizens of the right to hold it privately. The following year, the Gold Reserve Act transferred all gold to the U.S. Treasury and centralized control in Washington. These moves ended domestic convertibility and placed the nation's gold supply directly in the hands of the state, leaving the dollar's value to be managed by law, not by the weight of metal in a citizen's pocket. In July 1944, delegates from 44 nations gathered in the quiet hills of New Hampshire, determined to build a new financial order after the devastation of war. The agreement they crafted at Bretton Woods set the United States dollar at the center of the global system, promising that every $35 could be exchanged for 1 ounce of gold, held in the vaults of the United States Treasury. Every other major currency was pegged to the dollar, forming a chain of fixed exchange rates that linked the world's money to American gold. The International Monetary Fund was created to oversee this structure, offering emergency support while enforcing the rules of the system. Under this arrangement, central banks could convert dollars into gold, but ordinary citizens could not. The design aimed for stability. As long as the United States maintained enough gold to back its promises, confidence would hold. On paper, the world's money was anchored. Every currency in the end pointed back to gold in American vaults. But this architecture also meant that the dollar's strength became the foundation and the potential fault line for the entire post-war order. By the late 1950s, the world's demand for dollars was rising faster than the United States could supply gold to back them. Year after year, Washington ran balance of payments deficits to fuel global trade and recovery. Foreign central banks accumulated dollars, trusting that each one could be exchanged for gold at $35 an ounce. But the numbers began to tell a different story. In 1960, foreign claims on United States gold reached $22.8 billion, while the Treasury's gold stock had slipped to $21.8 billion. For the first time, outstanding dollar liabilities surpassed the nation's reserves. The gold cover ratio, once above 250% in 1950, fell below 100% by 1960 and kept dropping, just 52% by 1965 and barely 19% by 1971. Meanwhile, domestic inflation crept upward, pushed by wartime spending and new social programs. Economist Michael Bordo describes this as the Triffin dilemma. The system needed more dollars to keep growing, but every new dollar weakened the promise that it could be exchanged for gold. The reserve liability gap was no longer theoretical. It was visible in every chart and every central bank ledger, bringing the crisis to the doorstep of the global financial order. In 1961, 8 central banks formed the London Gold Pool. They pledged to keep gold at $35 an ounce through coordinated sales. When private demand surged, the pool's members, led by the US and the Bank of England, sold gold from their reserves into the market, hoping to drown out speculation. But the more dollars flooded world markets, the more tempting it became for foreign governments to swap those dollars for gold. France in particular began converting its dollar holdings and shipping gold from New York to Paris. By March 1968, the pool was overwhelmed. Emergency meetings in London ended with the system split in two, an official market for governments and a separate floating price for everyone else. Economist Carmen Reinhart notes that speculation and arbitrage had made coordinated defense impossible. U.S. gold reserves continued to drain, setting the stage for a final break. On August 15, 1971, President Nixon addressed the nation and announced the suspension of dollar convertibility into gold. The dollar was no longer tied to a fixed amount of metal, and foreign governments could not exchange their reserves for gold. By 1973, major currencies began to float freely. The Jamaica Accords of 1976 sealed the era of fiat money. Central banks then relied on new tools, interest rate policy, open market operations, and later quantitative easing to manage economies without the constraint of gold. As economist Kenneth Rogoff observes, this shift gave policymakers more flexibility, but it left the value of money anchored only by trust and institutional credibility. Today, every major currency floats untethered. Its value is shaped by trust, not metal. As inflation and digital money accelerate, the question isn't what backs our money, but what holds our confidence.